investing can be simple. Let us go through 10 simple financial ratios you need to know to start investing. Hi guys, Stanley here. There are tons of financial terms and ratios when it comes to investing. However, we only need a couple of them to be able to start investing. And every one of them can easily be found if we have the annual reports of the company. And we can also find the data from financial data site like Morningstar, which is free. So here are 10 financial ratios that can easily improve your investment skill within the next 5 minutes. First, let us go through how we can tell if a company can produce a good return from the capital it has. The return on equity is an important ratio telling us this information. The return on equity, or ROE, has the formula of net income divided by the company's shareholders' equity. It is telling us how much profit the company is making based on how much capital its shareholder has put into the company. So naturally, the higher this number is, the better. However, we can even take this one step deeper and break down the formula even more. Return on equity is also return on asset times leverage. This is because return on asset is the net income over the company's entire asset, and leverage is asset over equity. So the two assets cancel out and give us back ROE. But breaking it down allows us to understand the company even more. Now we can see how much profit the company is making over the entire asset, both funded by all its liabilities like debt and shareholders' equity. And we can see its leverage on whether the company is funded more with debt or equity. For example, if we have two companies that both have a return on equity of 10%, we can compare how they achieve that efficiency. Maybe company A has done it with a ROA of 10% with a leverage of just 1, while company B has done it with a ROA of 1% but a leverage of 10. With that, we know instantly that company B has an extremely high debt, and the only way it can achieve a 10% return on equity is by boosting the return through leverage, which can be very risky. On the other hand, company A can easily achieve a ROE of 10% because it has a more efficient business that is generating good return without any leverage. Thus, we know company A is a better company to explore further. Second, another great ratio to know is the net margin. Net margin is the net income of company over its revenue. It is how much the company is actually earning from selling its product and services. For example, a company like Apple has a net margin of 21%. This means that for every $1,000 of product that Apple is selling, it is making $210 from it. Pretty good. Compare that to a company like Xiaomi, which has a very similar business model. That has a net margin of just 5.5%. So, with the same $1,000 of product, Xiaomi is only earning $55 from it. Of course, the net margin of a company is changing every year, every quarter, and even every month. But as we look at how the net margin of a company changes, we can gain a better picture of the company. Mainly, we can see that if the company is growing or shrinking its business advantage or economic moat. This is because if a company makes a very valuable product that is highly sought after, you can imagine that it can charge a higher price for it, thus allowing it to earn a higher net margin. On the other hand, if a company is making a product that is not that special, it might have to compete in price, so it will end up with a lower margin. That is why I do prefer to invest in company with reasonably good net margin. Next, let us dive deeper into operational ratio. We will look at the days of sales outstanding, days of inventory, and days of payable outstanding. Then, we can tie them all together so we can see the cash conversion cycle of a company. If all this is not making any sense, don't worry, it will in a few minutes. Firstly, days of sales outstanding. It is a measure of how fast a company can collect back its money after invoicing its customer. The formula for days of sales outstanding is the average outstanding account receivables divided by the revenue and times the number of days within that financial period. You can find this information from the balance sheet and the income statement of the company. So if we look at Apple again as an example, its days of sales outstanding is the average outstanding account receivable divided by the revenue times the number of days within that financial period, which is 365 days. And you'll get a DSO of 32 days. This means that the company is able to collect back its money 32 days after invoicing the customer. Next, the days of payable outstanding has a very similar concept, but we are calculating how long before the company pays back its supplier. The formula for days of payable outstanding is the average payable divided by the cost of goods sold times the number of days. We can easily find the cost of goods sold by looking at the gross profit of a company. The cost of goods sold is basically the revenue minus the gross profit. And we can plug all these figures into the days of payable formula. We will understand more on how the company's relationship with its suppliers. For example, Apple again has a days of payable of 115 days. This shows us that the company can stretch up to 115 days before paying back its supplier. With a longer days of payable outstanding, it is suggesting that the company has a better pricing power over its suppliers. But if that figure becomes too large, maybe 6 months or above, it might indicate that the company has some cash flow issue and is unable to pay back its supplier. Another important ratio you must know is days of inventory. Again, the formula is similar. Days of inventory is just the average inventory divided by cost of goods sold times the number of days in the period. Going back to our example of Apple, it has a days of inventory of just 9 days. This shows us that Apple can turn over all its inventory every 9 days. In this case, a smaller number is better, showing that the company is more efficient in managing its inventory and do not need to keep a large stock to run its business. Finally, with all these three figures, we can form them together to see the cash conversion cycle of a company. The company with a lower cash conversion cycle is more efficient than one with a high cash conversion cycle. Cash conversion cycle, or CCC, has a formula of days of sales outstanding plus days of inventory minus days of payable. Again, with Apple, we can see that the number is actually negative 74 days. This means that Apple is actually collecting its revenue first before it needs to pay back its supplier. We can also see some other companies with negative cash conversion cycle. It is very common among retailers like Tesco or Amazon. This is because retailers typically let brands place their product in their store first, and when they sell it, they collect cash from the customers and then take their time to pay back the brand's owners. Therefore, they basically do not need any working capital to fund their business, as the brand owners and their suppliers are funding the retailers with their long payment terms, while the retailers always collect cash when they sell something. Next up, we can analyze the debt of a company. In a company, it is not the lack of business or tough competition that will kill a company. It is typically the debt. The two key ratios we can look into is the current ratio and the debt to equity ratio. The current ratio will show us if the company has enough liquid and short-term asset to meet its short-term liabilities. The formula is current ratio is equal to current asset divided by current liability. A current ratio of more than 1 shows that the company has enough short-term asset that can be turned into cash to pay back its short-term liabilities. A ratio less than 1 will alert us that maybe the company is in trouble in paying back its liabilities at the end of the year. Next is the debt to equity ratio. This compares how much debt the company is holding in comparison to its equity. A company that is funded with more equity is generally safer than one with high debt. The formula is just total debt divided by total equity. A company with a debt to equity of more than 1 means that it has more debt than its shareholder equities, adding more stress to the company if it meets a crisis. I tend to look for companies with a debt to equity of less than 1 to ensure that the companies I invested in are less risky. Finally, the last ratio we need to know as investors are valuation ratio. These tell us if the stock is trading at a high or low valuation. We discussed before in previous video that the actual share price of a company tells us nothing about whether the company is expensive or cheap. For example, just because Alphabet or Google is trading at more than $1,500 a share, it is not more expensive than the stock like C Group with a stock price of just $163. Instead, we should look into ratios like the price to earnings ratio to determine if the company is cheap or expensive. The price to earnings ratio, or PE ratio, is calculated using the stock price divided by the earning per share of the stock. It is showing how many times is the stock price compared to the earnings of the company. So again, with Apple, it is trading at $111 per share now, while having an earnings per share of $3 last year. This means that it has a price to earning ratio of 37 times. Then we can look at a company like Netflix with a share price of $486 and an earnings per share of $4.10 per share. So Netflix has a PE ratio of 118.5 times. From that, we may conclude that Netflix is more expensive than Apple because Netflix needs to earn the same profit 118.5 times before it can match what the company is valued at today. Another valuation ratio we can use is the price to book ratio. It is used more commonly for companies with large asset base like a bank, a property company, or a REIT. The formula is the stock price divided by the shareholders' equity per share. A company with a price to book ratio of 1 means that it is valued exactly the same as its shareholders' equity in the balance sheet. And a company with a price to book ratio of less than 1 means that the market is valuing it less than what its equity is. So in theory, such a company might be more valuable if a shareholder buys out the company, liquidated it, and pocket the difference. Of course, this is just in theory. So there you have it. With all these 10 ratios, you can easily tell if a company have a good business model by looking at its ROE and net margin. You can see how efficient its operation is by looking at its cash conversion cycle. And you can also analyze the risk level of a company by looking at its current ratio and debt to equity ratio. Lastly, you can even value a stock using the price to earnings and price to book ratio. All of that will help you make a better decision on your next stock investment. If you want to dive deeper into understanding how to invest in the stock market safely, you can look into our free online course at valueinvestasia.com/free course. We will go even deeper into all these topics. And as always, that's it from me. My name is Stanley. Till we meet again, invest safely.